A mortgage broker or mortgage agent is insured and licensed by the Government of Ontario, by the financial community. Whereas a person that's at the bank is an hourly person. They are not licensed. They are simply there to collect your information and then gets forwarded over to someone in the head office that specializes in mortgage applications. So you're dealing the entire time, if you go to one of the big 5 banks, you're essentially dealing the entire time with someone that is A, not licensed, B, not aware of what's actually out in the market, and C, which is the most important, they don't have your best interest. They're being paid by the bank, so therefore they're trying to make the bank money rather than trying to get you the best product available. Every time you essentially get a mortgage application, it's more or less 40 points off your credit score that it knocks out. So you go to a mortgage broker, it's one time. I run it once, it's good for 90 days. So within 90 days, I can send it to 10 different lenders. They don't need to pull it again because I send them a copy with my application. If you go to a mortgage broker, you have the option of going to alternative lending, which is sort of like for self-employed or people with bad credit or coming out of bankruptcy or coming out of post-divorce messy situations and everything like that. Things that if you go to TD, they'll just be like, sorry, come back in 2 years. Once you're clean and clear, because that's all they can take is clean and clear. If you go to a mortgage broker, I'll get you someone else. The overall scope of going to a broker versus bank really comes down to choice. Go to TD, they will offer you 3 products. You don't like it, or you don't like their rate, or you don't qualify for what they say, sorry, you gotta go somewhere else. Go to a mortgage broker, suddenly you have hundreds of options, and most of the time I can get you 4 or 5 options before I even send it to anybody. So anything below 600 is considered bad credit, not because you're irresponsible necessarily, but because the bank views it as a higher risk. So me as an agent, my job is to mediate between you and the bank, but I protect you, not the bank. My interest is you because you came to me, you are my client. The bank is just someone that lends money, so I don't have to protect them. They have their own protections in place. I have to protect you and get the best product for you. So if you have anything essentially below 640 is considered okay. So below 640, usually you have a premium on the interest rate, 0.25% higher. If it's below 600, a lot of lenders won't touch you. Now, there are alternative lenders who will give it to you even if you're at 440, but you will pay for interest rate. You will pay an interest rate that is going to be a bonus of an additional 4 or 5%. So you still get financed mostly. Anything below 680 and what's called A lenders, so the prime lenders, will not consider. So then we have to go to a B lender or an alternative lender. Some monolines, again, monoline is a bank that is registered, but they don't have an actual physical branch. So some monolines will go down to 640 or even 600 on certain promotional products. But essentially 680 is the make it or break it. If you want to have the best mortgage possible, 680 is your mark. How do you get to 680? 2 things. Never have more than 60% debt load. So you have a credit card and a car payment. Car payment, you can't control how much you took out. Because you took out $30,000, so you're paying it out. Now you can't control it. But a credit card, or 2 credit cards, or a line of credit, those you can control how much they are. Never exceed 60% of the maximum limit. If it's a $10,000 card, don't exceed $6,000, ever. Now you can exceed it for a week, but then pay it down. So before the next cycle, you're back to $6,000. Because every dollar over 60%, it costs you demerit points on your credit score. So it takes away your credit score. Instead of maintaining it or slightly building it slowly over time, you're actually dropping it. If you just maintain your 60%, it'll take you a year and a half to 2 years to get up to good score. So 680 is considered a good score. If you pay down your debt ratio and from 60% down to 30%, you'll speed it up in less than a year. If you pay down that altogether and just use it for daily spending, fuel, and whatever, and then have a zero balance at the end of every statement, within 6 months you can be up to 680, 700. If you have a consistent history of missing payments or being late, that kills you. That's the biggest thing, that what most people don't understand is there's a date on your bill, pay it 4 days before, because that bill date gives you a 4-day grace period before it starts reporting as a late payment. And when they mark you as being late on the credit, they don't mark you as being late 1 day. It's either 0 days or 30 days. The biggest thing you can do is essentially make sure you're over that 680 mark, because you want to qualify for the best mortgage possible. You don't want to have to pay an additional 0.25% or 1% or whatever because of a slightly below the threshold mark. You just don't want to, because that costs you money. So you don't want to do that. Every debt you have, so credit card, student loan, line of credit, anything other than a mortgage, you may be paying to the bank a minimal amount. When we put it into the computer to apply for a mortgage, we have to use a 3% calculation. So if you have a $10,000 credit card, you may have a hold of 0% for 6 months or 9 months because you have a promotion and you're paying 0 interest on it. I have to use 3%. That's $334 that's added to your monthly borrowing power that cuts that $334 out. So it's very important for people to understand that having a promotion on your credit card benefits you in no way when you're applying for a mortgage. If you're planning to buy a house or a townhouse or an apartment, buy that first so that you have as much buying power as you can, because your ratio of debt to your income is maximized. Then you can go buy the car. Literally, it takes the lender 2 days to register your mortgage. 3 days later, you can go buy your car and max out your credit. If you are so inclined, it will hurt you. But if you're so inclined, you can do it. I wouldn't. But hey, every client I have, the first thing I tell them when we sign paperwork, from the day we apply until 2 days after you got the keys, do not use your credit card or anything unless you're getting fuel and food. That's it. For the duration between when we've applied for your mortgage and when it's closed and registered, which is usually 2 days after you got the keys, do not buy anything big. People buy a house, and before the house closes, they go and they buy the furniture. And they go and they spend $15,000 on furniture because, hey, they're going to move in next week, so they went and they ordered it from Leon's, from wherever. It hasn't come yet, but they've paid for it. The day of closing, the lender always checks your credit again. Guess what? They see you just spent $15,000 worth of stuff that you didn't have. Guess what the lender is going to do? I'm sorry, $15,000 means $450 a month payment. You can't afford that because we already allowed you the maximum. So your mortgage is canceled. Pre-approval is essentially a piece of paper that means nothing to anybody. I know realtors like to say, hey, did you get pre-approved? I can pre-approve you right now if you tell me how much your salary is and how much your credit cards and car payments is. I can tell you approximately how much you can borrow. Does that mean you will actually get that mortgage? No. Because a pre-approval is literally just me quickly looking at your numbers without seeing any actual paperwork. The way to do it so that you know what you're getting is you come to me, we sit down, we talk about it, and I give you an actual solid numbers based on your paperwork. I look at your T4s, I look at your taxes, I look at your tax returns, and then I pull your credit report and I say, okay, here's the debt the person has. Then we put everything in. So then when I send it to a lender, then I get a written pre-approval directly reviewed by an actual person. What that means is somebody sat down, put all the numbers, figured out everything, put everything into the computer, sent it to a lender for review with all the documentation, and then the lender will send back a written pre-approval saying, hey, for the next 90 days, this is the rate we're going to give you for this much amount. Take your total salary, combined home salary, pre-tax. So we don't worry about the taxes. The bank doesn't care about the taxes part. So we take your pre-tax amount, let's say $100,000. We know that for the house, so for the principal, the interest, the tax on the property, and the heat, which is $100, all those four have to be no more than 39%. We also know the total combined, including car payments, line of credit, furniture payments, whatever other credit card payments, all of that has to be less than 44% in order for us to qualify for a good mortgage. 20%, everything below 20% down payment, we have to follow government regulation. We can't avoid that 39.44, can't avoid it. As soon as we have 20% even, we now no longer need to follow the government mandate. So 19.9%, you have to. 20% even, you no longer have to. So suddenly, we can now go 30 years amortization. We can extend that 44% to 46 on exemption, 48, even 50 with some lenders. If we stretch out the numbers to a higher debt ratio and a longer amortization, we can, depending on your situation and your desire and home and location, can get you, let's say, almost 200 grand more. Does it make a difference? It makes a huge difference. Is it necessary? No. But there's a lot of things in life, they're not necessary. But it just goes to show you that the numbers work in your favor if you can have over 20%. If you still want to essentially have a life, make sure that all your debt, so combine all your debt on paper, has to be less than 50%. Because anything over 50% becomes uncomfortable. That will still give you enough breathing room to be able to take a weekend off, to be able to take a vacation once a year, to still have car, and God forbid it breaks and it's not under warranty or something happens and you have to take a few days off. It doesn't bury you in 3 months worth of credit card debt, because that's the hardest debt to get out of, is credit card debt. If you know you're planning to buy a house this year, clean up your credit as fast as you can. Reduce as much of the debt as you can. Because reality is, if you're planning to buy a house this year, it means you're trying to save a down payment. The down payment is essentially going to be worthless if you have credit card debt. So that's the first thing. First the credit card debt, then the down payment savings. So that's the first thing. Without that, you're not going to buy a house this year. That's just the reality. Second, if you are planning to buy a car or you think you might want to buy a car, wait. Just wait it out till a few days after, then go buy the car. Don't literally shoot yourself in the foot by buying the car first and then not being able to afford the house, or worse, lose your deposit because you did something in the process. Don't buy furniture, don't buy anything else while you're in the process of closing. You put a deposit on the place until you get the keys, and 2 days later, don't buy anything. Food, that's it. Go celebrate 3 days after with your wife, not before. Fourth thing, I guess, is try and avoid paying payments on your credit on the due date. It's something people don't realize, but avoid doing it. Just pay it a week before. If you can pay it twice a month, even better, but at least a week before, and try and stick under that 60% limit. 60% of the total per card. So if you have 3 cards, it's 60 for each card. Not 60 overall, because you may have one card that's 100, another one at 20. You want to have it 60 per card, because that's what makes the difference. It's 60 per what they call trade line. So each debt is considered a trade line on the credit report. So you want to stick to 60 for each trade line as max. And if you got those, there's no reason why we can't sit down and work a plan out. The only other thing I'll say is, if you're young, like 25 and under, a lot of lenders will not say this out loud, but they will not like it if you don't have any kind of credit. They will not want to give you a house credit if you don't even have a credit card or a car payment of some sort. So my suggestion, if you're under 25 and single, if you're married, this doesn't apply to you. But if you're under 25 and single, get one credit card as soon as you can. Pay it off. Don't keep a monthly amount on it. Pay it off and get a small, cheap $10,000 car. Even if you can afford to pay in cash, get a loan. Because that shows that when you go to apply for a house, that shows the bank that you took financial responsibility with debt and you were responsible. Therefore, they're more inclined to give you a loan on a house and a mortgage than they are if you just show up and be like, hey, but I paid with everything with cash. Because that's awesome for you. But for the lender that says, well, this person has zero history with big purchases and we're going to give them $300,000. They don't even have a $1,500 credit card that they've shown history for. So if you're young, get a credit card, get a small car loan. On my website and on my portfolio, I have a mortgage calculator that's specifically attached with all of my products that I can offer and everything like that. So people can download that. The other option is that, everything is available online these days. So a simple Google search will get you pretty much everything you want to know. But at the end of the day, and not to sound cliche, nothing is as valuable as sitting down with an actual agent or a broker and just be like, hey, here's what I'm thinking, even if it's not now. Trust me, I would prefer you come to me now when you're thinking that in 4 years you want to buy a house, because you're just thinking now, you're starting to do the research, you're not planning to do it. Come to me now so we can sit down and get you a plan going in the right direction, so when the time does come, we can actually get there.